Hello, everyone, and thank you for attending today's webinar, State Fiduciary Income Tax, including discussion of the Kaestner case, S-Corp ownership, and basis step-up strategies. Before we begin, we wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. A copy of today's slide deck is available on the resource widget. We encourage you to download any resources or links you may find useful. And again, with the email that we sent to begin with, you have a link to my newsletter that has details to support everything that's in these slides. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. This webinar is CLE accredited in Missouri for 1.8 hours of general credit, and Illinois and California for 1.5 hours of general credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. We value your opinions and appreciate your participation in the course. And for sure, let me know if there's anything that you think I should be covering in my quarterly webinars and my newsletter. So with that, we get going with the substance here. So next slide. Slide 3. So we're going to, first of all, talk about what the Kaestner case did and didn't do regarding the constitutional limits imposed on state income taxation of trusts. And we'll discuss how state income taxation affects pass-through entities. Trusts that own pass-through entities, how all this affects their taxation. Then we'll discuss recent developments in S-corporation ownership and shareholder agreements. And then we'll conclude with an overview of basis step-up issues, including discussing some of my formula that was in my newsletter, and we'll also talk about a recent private letter ruling on a trust modification. So on the next slide, slide 4, so the Kaestner case was a unanimous Supreme Court decision that said that North Carolina cannot subject to income tax a trust whose only ties consisted of a beneficiary who may at some point receive distributions in the trustee's absolute discretion. And the Supreme Court expressly limited its holding to the circumstances in which a beneficiary receives no trust income, has no right to demand that income, and is uncertain necessarily to receive a specific share of that income. So it was a relatively narrow holding. Slide 5. The court did not discuss whether, if the trust had made distributions to the beneficiary, North Carolina could have taxed her. The court also noted in passing, and without pausing for a single instant, that in a year after the taxable year that was the subject of litigation, the trust was to terminate when the beneficiary reached age 40. But instead of waiting until the beneficiary reached 40 and giving the money to the beneficiary, the trustee, before that time, decanted into a new trust. Just to make sure everybody knows what decanting means, decanting is when a trustee exercises the trustee's power to make distributions and creates a new trust and pours part or all of the old trust into the new trust. So in this case, the trust said, "Thou shalt terminate the trust at age 40." And the trustee said, I'm going to put it to a new trust that doesn't terminate at age 40. So the beneficiary, by the way, did not object to this decanting. Now, there are some potential gift tax issues from decanting. So, the beneficiary had essentially a general power of appointment, potentially, that the beneficiary did not make sure it got preserved. I mean, the beneficiary could have objected and say, hey, you're taking away my withdrawal right. No can do. And could have objected to try to preserve the beneficiary's rights. And Normally, we would get concerned about a taxable gift, something like that, and we would take steps to make sure that the transfer to the new gift, that the new trust would be considered to be an incomplete gift by the beneficiary to the extent the beneficiary did not object. But in this case, they did the decanting with no objection, and so the benefit, in other words, like a year or two after the taxable year that was being audited, the beneficiary had a right to receive everything, and the trustee took that away. So, the beneficiary's rights, in some ways, were not really illusory the way that the way the court kind of made them out to be, because the beneficiary had this right and could have objected. So, we don't know what would have happened if the beneficiary had objected, what kind of, how the courts would have viewed that exercise of discretion by the trustee to decant. So, that's a question for another day. But this was not just a purely contingent trust, because this withdrawal right is essentially a withdrawal right. It was a really big deal. So let's go on to slide 6. So how might this affect other states? So the next slide is slide 6. There are footnotes, 12 to 13. And so North Carolina said, hey, if you take away our ability to tax this trust, it's going to affect other states. So be careful what you're doing, because you're really undermining what a lot of other states are doing too. So here's you can see the quote from the footnote that North Carolina pointed out that there were 10 other states that are subject to income tax trusts that look to the beneficiaries in state residency. But the court pointed out that 5 of the other states consider beneficiary residence and one or more other factors. And so those states may very well be different. The court didn't really say whether it thought they were different. It just basically was indicating that they may very well be different. And you can see what those states were, and they include my home state of Missouri. So then of the states that don't have another factor, they said, well, Montana and North Dakota, well, might or might not rely on the beneficiary's residence alone. And whether Georgia can do it on the sole basis of residence, that's disputed. And Tennessee, well, that's phasing out its income tax, so who cares about Tennessee, because this is going to be moot for Tennessee in a couple of years. And then that leaves California, which applies its tax on the basis of beneficiary residence only where the beneficiary is not contingent. So the point that the court was saying there is, well, here, we don't know whether distributions will ever be made. California says if the beneficiary might not ever get distributions, we won't tax the beneficiary. But California does say, well, if you have a California beneficiary and you accumulate your income and don't pay California income tax, but you later make a distribution to that beneficiary, well, then we're going to nail you with taxes on that accumulated income. And the Supreme Court said, well, the trust didn't raise any challenge to this throwback rule by California. Of course, I don't know how the trust could have raised an objection, because North Carolina doesn't have a throwback tax, and a throwback tax was not an issue, so I don't know how the trust could have raised a challenge. So that seemed kind of a gratuitous comment by the court. But anyway, so basically the court was saying, hey, North Carolina, you're the only one who's really trying to truly nail somebody who doesn't receive distributions, and you're out of here. You're not going to collect this tax for these. Okay, so let's go to slide 7. So I attended a meeting that included some people who were at the oral hearing, and I also included some people who participated in the case on behalf of the family, as well as people who helped with ACTEC's amicus brief. And Some of the people who were very familiar with what was going on in North Carolina said that the counsel for the state struggled to explain how state and federal income taxation are connected, and later in a public forum admitted that he got raked over the coals by the Supreme Court justices. So counsel for the state basically admitted that he didn't do a good job. Now, I don't know if he did a better job, that there would be any different outcome, because the bottom line is that the trust still didn't have a significant connection if you ignore that mandatory termination at age 40. It really wasn't mandatory after all. Also, they mentioned some lawyers who were familiar with the case mentioned the North Carolina bar has in the past proposed a statute that would have passed muster, but the North Carolina legislature declined to address the issue. So they were hoping to keep this as expansive as possible. And at least 400 protective claims for refunds have been filed by the end of June. And so the North Carolina Department of Revenue established procedures for refund claims. And, of course, I have a link there in the slide. So let's go on to slide 8. And since then, the court has declined to review a Minnesota Supreme Court case called Fielding. And before I go back to talk about the future of state income taxation or trust, let me just mention what happened with Fielding. So in Fielding, a trust owns shares in an S corporation. And the Minnesota Supreme Court said that taxing the trust on other income other than the S corp, violated the due process clauses of the U.S. and Minnesota constitutions, which are viewed as identical to each other. Let's go on to slide 9. But nobody disputed Minnesota's ability to tax the trust's distributive share of the S corporation's Minnesota source income. So it was only the other income from the trust, like income from investments or stuff like that. So the trust didn't have any contact with Minnesota other than indirectly through the S corp's activity in Minnesota, and that activity from Minnesota was getting taxed already. So the trust had zero other contact for its other income, so it was not fair to tax the trust on that. So what do we think about what kind of signal the court is sending about its interest in this? So a lot of people who are really big into state fiduciary income taxation were really hoping to get guidance. I mean, I certainly was. So, what are the limits of due process when a state can tax a trust? And in Kaestner, it was only a beneficiary. In Fielding, the only contact was that the grantor had been in Minnesota at the time they set it up. So, if those are your only contacts, is that enough? And so we were hoping to at least get some guidance on it. And the people who were at that meeting I attended felt that when the Supreme Court took on Kaestner, that it really wanted to give you some really meaningful guidance. But then when they saw the briefs and the amicus brief and everything else, they realized, hey, fiduciary income taxation is complex and it's hard to get a handle on. And we're afraid we're going to make a mistake, so we're just going to do a very limited holding here. I have to realize that back when it heard the Knight case, I don't remember exactly how long that was, maybe like 10 years or something like that, on whether a trustee's fee would be considered to be miscellaneous itemized deductions or not, that the Supreme Court asked questions at the oral argument such as, what's all this talk about grantor trusts? Don't all trusts have a grantor? So the court really was pretty clueless about cases when it did this Knight case or O'Neill or whatever you want to call it. And in fact, a lot of us think that the court got that case wrong. But the bottom line is that the Supreme Court doesn't know trust, and it is uncomfortable with trust, and it thought it might be able to do some good in the case. At least this is kind of what people are reading between the lines. They thought they could do some good with Kaestner, and then they realized that they bit off more than they could chew, and they did a very narrow holding, and then they denied certiorari to Fielding. So, I mean, what if the only connection for the trust is a grantor? Does that satisfy due process? I mean, you would think that would be something that would be of interest that we could get some clarity on, and it really would have been helpful for them to rule on that. So, I think a lot of people think that this case indicates the court decided against providing any helpful guidance in state fiduciary income taxation and no longer wants to tackle the issue. So basically, we'll just have to see what the other federal courts do, and a lot of these cases seem to be coming up through state Supreme Courts. And part of that is because there's state constitutional issues. I mean, the Supreme Court could have even denied cert in Kaestner and just said that the North Carolina Constitution took care of it, but they didn't. But I think that we're just going to have to look at those state Supreme Courts generally and see what we go on, what they do. So we'll have a patchwork of rules. So what else is new? That's part of our federal system. Let's go on to slide 10. So, we talked about, really this was more about fiduciary income taxation on investment income. And of course, the point of my newsletter is planning for business owners. And so what happens if you have the owner of a pass-through entity? So, normally, first of all, if you had a C corporation, so it's paying its own taxes, the C corporation would pay tax in any state in which it does business, and there are some state apportionment statutes that kind of talk about what are the facts. They have very factors like property and wages and sales and all that kind of thing. Various ways to apportion the business's income. And they have this for C corporations, and they also have this through pass-through entities. So when you have a pass-through entity like an S corporation or a partnership, then, what happens? So first of all, the state could just choose to directly tax the entity. There's no federal law that says that just because you're a pass-through entity for federal income taxation, you have to be that way for state income taxation. Now, states generally will respect the federal income tax treatment and tax them as pass-throughs. But that's not the case with every single state. There are some states that are a little bit different. Then the other question is with the state, okay, so the state could tax the business entity, and it doesn't tax a business entity. So it chooses to tax the owners. So it's really taxing owners in lieu of taxing the business entity. So that seems fair for that to happen. Now, there are usually a couple ways that the entity can handle things. So first of all, let's suppose you have a business entity that does business in all 50 states. So does that mean that any owner of a pass-through entity that does business in 50 states is going to have to file 50 state income tax returns? Well, I shouldn't say 50 state income tax returns because not all states impose income tax, but 40-something income tax returns. So, that might not be very convenient for people. So, what states tend to do is what pass-throughs tend to do is they might do what we call a combined return, or there's another word that slips my mind. But they can file a return and pay tax on the owner's share of income. So they can elect to pay that tax at the corporate level instead of at the owner level. So, generally they would pay it at the state's highest rate, so the state is not losing any revenue by having the entity pay it instead of having the individuals pay it. Now, the individuals may or may not be happy with that. If the state income tax from a particular state would be relatively low for that individual, then it's possible that the cost of preparing a return might be a lot higher than the tax savings they get by filing the return themselves instead of having the corporation or whatever entity is pay the tax. So if you have a relatively small amount of income from a particular state, then the entity would tend to just file that return and pay that tax on behalf of that owner. If, on the other hand, the amount of income tax for that state is relatively material, then the individual owners may very well want kind of the run-up in the brackets at the state income tax level and say, no, give me my K-1 from the state, I'll pay the tax myself. But regardless, when we have these pass-throughs, the whole point is the business entity has a connection to the state, and either the entity or the owners needs to pay tax on the income that is connected to that state. And nobody disputes whether a non-resident of that state should be taxed on income from that state because of that entity doing business in that state. Nobody disputes that. By the way, the last bullet point here, there is a potential for double taxation or worse because the states use these various factors, and the states are inconsistent on which factors they use. So for anybody who does have a concern about double taxation, generally the states have entered into a multi-state tax compact, and there's an organization called the Multi-State Tax Commission that can kind of help bring the states together and provide a forum for making sure that the business doesn't get double taxed. And my newsletter and the supporting materials have a link to the webpage for the Multi-State Tax Commission. Okay, let's go on to slide 11. I mentioned before about being a C-Corp, paying tax on its own income, which simplifies things because it can pay tax on its income at whatever appropriate rates it has, and that avoids owners needing to file income tax returns in multiple states. The other thing is that remember that 2017 tax reform limited the state income tax deduction for an individual to $10,000, and that's even if they itemize. So the owner of a pass-through entity is subject to that $10,000 limitation that applies to state income tax and personal property tax and personal use residence tax, real estate tax. And so if you're a pass-through entity, the owners have to contend with the idea that they might not be able to deduct any or maybe only a small part of the state income tax they pay on the business income. On the other hand, if the income got trapped inside a C-Corp, then the C-Corp deducts the state income tax without any limitation whatsoever. It just gets to deduct that state income tax, and so that is a benefit of being a C-Corp. That doesn't mean I love C-Corps. So those of you who've seen my past webinars or listened to me speak know that I very much believe that a C corporation is like a Roach Motel. So I'm not a big fan of it, but I did want to just point out the dynamics of being a C Corp, simplifying things for its owners, and getting a better federal deduction of the state income taxes paid. Let's go on to slide 12. In addition to talking about just the taxation of the annual income, I also want to make sure that you're sensitive to the dynamics of when a pass-through business sells its assets. Now, in a webinar earlier this year, back in January, I talked about the exclusion from sale of stock in a C Corp, and I compared that to income taxation when a pass-through business is sold. And generally, what's going to happen is when somebody buys a business, would they rather buy stock in that business or would they rather buy the business assets? And the bottom line is that normally, from a tax perspective, they would rather buy the business's assets because that will let them depreciate the assets or amortize the goodwill or other intangibles. So they would rather buy the assets. And the other thing that I mentioned is that when you sell an S corporation or a C corporation, whenever you sell the stock in a corporation, you can elect to have that sale of the stock be treated, instead of a sale of the stock, as instead a sale of the business assets plus a liquidation of the corporation. And so there's a particular election to make for that, and that lets you transfer the stock, which you may want to do for state law purposes, because maybe you have a bunch of business processes going on inside the entity, or maybe you have licenses that are held, and you want to keep that state law entity going, so you might want to just sell the stock instead, but you want to get the tax benefit of selling the assets. So that's why you tend to make that election. So let's suppose you had a business that had assets with a zero basis, and it had $1 million worth of assets. So if you sold the stock, you might have like $1 million capital gain. Now let's suppose that you were an S corporation or a partnership. If instead you sell the assets, you'd have $1 million gain on the sale of the assets, which would pass through on your K1, and that $1 million gain passing through on your K1 adds to your basis. So now you have $1 million basis. So when you liquidate that pass-through entity, you have $1 million of proceeds minus $1 million basis, or zero gain. So whenever you're going to be selling the assets and you have a pass-through, that's going to generally just wipe out your gain on the sale of the business entity. So that's pretty cool, and it works very well for federal income tax purposes, for the asset sale to cause only the asset sale to be taxed and not the sale of the business. Another possible scenario is, suppose before selling the business, the owner died. Suppose you owned 100% of an S Corp and it was worth $1 million. So here's kind of a cool thing that can happen with that. So you have a base stuff up to $1 million, and you sell the assets for $1 million. Well, there's still $1 million on the K1 from the sale of the assets, if you sell the assets. But then, when you go to liquidate the S Corp, you would have $1 million of proceeds, and your basis is $2 million. The $1 million basis step up plus $1 million from the K1. So you have $1 million proceeds minus $2 million basis. That gives you $1 million loss on the sale of your stock in your S-Corp. And then if the sale of the business's assets is taxed as a capital gain, then you can offset the capital loss on the sale of your stock and wind up with a big fat zero in income. So that's what happens when you own 100% of the S-Corp, for example, and you die and then the business gets sold. You can avoid the gain on the sale of the assets, essentially, because of this offset. Now, this $2 million loss, there's some with all that, the $1 million loss wiping out the $1 million gain, that's at a federal level. At a state level, there's some more complexity that goes with it. So first of all, in your state of your residence, it works totally fine. It'll follow the federal. But let's suppose that we had an S-Corp that's located in Missouri, that the owner is in Missouri, but the assets were located in Illinois. It's supposed to have real estate in Illinois. So we know that Illinois is going to tax that $1 million gain on the sale of the assets. What about the $1 million loss on the sale of the stock? Well, because the owner lives in Missouri and stock is intangible property, that stock is sitused in Missouri. It is not sitused in Illinois. The individual doesn't live in Illinois. The stock never set foot in Illinois. The stock is in Missouri. So Missouri will have $1 million loss to offset the $1 million gain on the K1. But Illinois will have that $1 million gain, and you will not be able to offset the Illinois gain from the sale of assets with that $1 million loss on the liquidation. So that is a nuance to state income taxation. And when I first saw a client who had that situation, it really sensitized me to the fact that this S-Corp, this deal with S corporations and offsetting loss against the gain doesn't really work for the states. So I just wanted to get everybody sensitized to that. Now look at slide 13. That's more of the same topic. If a C-Corp sells its assets, it's taxed wherever the assets are cited, and the owner's stock basis does not increase on account of that income. And so if you do wind up selling the assets from the C-Corp and then liquidate the C-Corp, there's going to be double taxation. Taxation on the gain on sale on gain on the sale of assets, and taxation at the shareholder level on the distribution of that. Okay, slide 14, just some other nuances in state income taxation. So first of all, we have this deduction for qualified business income earned by owners of pass-through entities. So that's Code Section 199A. It lets you deduct up to 20% of your qualified business income. Now, it turns out that deduction is available in only a few states. And my materials mention which states that is. And if you have a really, really keen interest in it, email me for my latest PDF. And my latest PDF will mention where I have saved a 50-state survey on the topic. And I ran the survey through Checkpoint. RIA Checkpoint has a nice tool that lets you do state surveys. So I did a survey, so I saved the document. So I do have that document available. So if you really, really want to, let me know. Okay. Other developments in state income taxation is this Wayfair case, which was a key decision in 2018 regarding the taxing nexus in the context of state sales tax. But that case really dealt with the Dormant Commerce Clause and not the due process. So that's different. So you should know there was a Supreme Court case that affects state taxation, but that's really not relevant for the state income tax issue we've been doing. And then finally, I wanted to bring your attention to another resource, which is the Council on State Taxation. And basically, this is a nonprofit organization that really is, for a lot of the big corporations, they have their own tax directors, inside. They have their in-house people who do taxation, and they even have, a lot of times there's tax directors have a keen interest in state income tax, and they kind of want to know how state income tax schemes affect their business. If you do business in 50 states, then what is your effective state rate going to be? And when you make a decision, and it may have a federal effect, is the state effect going to carry through in the various states? So the tax directors for big companies are really interested in how the various states treat things. And the Council on State Taxation will track differences between federal and state taxation. So I'd encourage people who have a keen interest to go look there as well. Okay, so that wraps up the state income tax discussion. I hope you found this overview helpful. And we're going on to slide 15. Recent developments in S corporation ownership and shareholder agreements. Now, as many of you know, S corporations, again, the owners elect to pay tax on their distributive share of the S corporation's income. So the owners pay tax on the S corporation's income rather than the corporation paying its own tax. So again, for federal income tax purposes, and frequently for state income tax purposes, the shareholders pay the tax rather than the corporation. So there are a couple of recent developments I want to mention. So first of all, I want to talk about the fact that ownership is restricted to who can own it, and we're going to talk about one recent development of that. Then we're also going to talk about the fact that a corporation can have only a single class of stock. How does that work? When are you within a safe harbor, and when do you violate that rule? And then finally, I'll touch on the ownership of stock that an employee has received as compensation, and it's vested in that employee, but there's a part of the 2017 tax law lets you defer taxation. So I'm going to talk about the consequences of that. So that's my S Corp potpourri. Let's go on to slide 16. Okay, so the rule is that a non-resident alien, so that would be a person who is not a U.S. citizen and not a resident of the United States. So a non-resident alien may not hold stock in an S corporation. So they cannot hold it directly. However, they might be able to hold it indirectly under a provision in 2017 tax reform. So one of the types of trusts that can hold S corporation stock is a trust where they have, in effect, what's called an S election. I'm sorry, like the ESBT election. And that ESBT election is it basically says that any S corporation income on a K1 that the trust receives will be trapped inside the trust at the highest level. Now, there's an exception in the ESPT taxation, and that is if an ESPT is a non-grantor trust, it gets taxed inside of the trust. But if an ESPT has a deemed owner under the grantor trust rules, then that deemed owner is taxed on the income instead of the trust being taxed on the income. So here's a potential trap for the government. So you have this non-resident alien who may be the deemed owner of part or all of the ESPT. And so now, if it's taxed to the non-resident alien, and the IRS doesn't have any way to go and audit the non-resident alien's return, because the non-resident alien is not subject to the jurisdiction of the United States. They're out of our country, so we can't go and tax them. I mean, you might be able to impose some kind of a withholding regime, which does quite often happen with various types of income. But, so what happens? Is this some kind of a trap for the government or a loophole for the taxpayers where a non-resident alien being the deemed owner, they may be able to pull a fast one with the grantor trust taxation? So the government put out some regulations that said, well, if the non-resident alien is deemed to own part of the trust, we are not going to apply the grantor trust treatment to that part. The S-Corp part, I mean, this is a legislative grace that the non-resident alien can even be part of that trust, and we are going to simply trap that income inside the trust. So if the non-resident alien owns 40% of the trust for income tax purposes, and the other 60% is a non-grantor trust, the bottom line is 100% of the trust S-Corp income is going to get trapped inside the trust. And of course, to the extent that the non-resident alien is a beneficiary and the trustee is trying to figure out what to do, then that tax would naturally affect the non-resident alien share of distributions, et cetera. So that's their workaround on it. So then I thought, well, does this mean that a non-resident alien could maybe just own the stock of an S-Corp and a revocable trust and then just elect ESPT status? And so that way you can get around the whole prohibition against the non-resident alien owning part of the trust, part of the S-Corp. So just put it into the revocable trust, and then you've kind of gotten totally around that. So I noticed in the new regulations that they specifically said in an example that the trust in the example was a domestic trust. So it's kind of like, okay, well, why couldn't it be a foreign trust, and the non-resident, the foreign trust just gets, taxed on the income, but maybe there's some kind of withholding regime or something that applies to that. I don't know. But what I discovered is that something which I already had in my materials but didn't really focus on before. The only way that a trust can be a permitted shareholder in S-Corp is if it's a domestic trust. So even before the new regulations came out, an ESPT or a QSST for that matter, or a grantor trust for that matter, they all must be domestic trusts. Now, if you go and look at the rules between what's a foreign trust and a domestic trust, even the slightest amount of control by a foreign person will make the trust be a foreign trust. So if you have a non-resident alien who sets up a revocable trust, then that's almost certainly going to be taxed as a foreign trust. And therefore, since it's not a domestic trust, would not be an eligible shareholder. So you can't just go around having the non-resident alien set up a revocable trust. It really needs to be some part of an irrevocable trust that has enough restrictions on the non-resident alien's powers to make it be a domestic trust. All right, let's go on to slide 17. So an S corporation cannot have more than one class of stock. And the statute also says that differences in voting rights do not by themselves create a second class. What do you do when you determine whether there's two classes of stock or not? You look only to the governing positions. And my slide here quotes from the regulations, corporate charter, articles of incorporation, bylaws, applicable state law, and binding agreements relating to distribution and liquidation proceeds. Because the second class of stock regs focus on the rights to distribution and liquidation. Go on to slide 18. And then the other point is that even if you have identical distribution liquidation rights, but for some reason the distributions are timed a little bit differently, then you're still going to be okay. So here's an example. Let's suppose that we have an S-Corp, and it has some non-resident shareholders. They're U.S. citizens, but they simply reside in a different state than wherever the S-Corp does business. So those shareholders are going to get taxed on that state's income Well, the state wants to make sure that these non-residents are going to pay tax. So it's going to require that either the S-Corp pay the income tax itself, or that the S-Corp will withhold income tax from the shareholders' distributions. And a lot of times what will happen is that the corporation will just pay the state income tax on behalf of those shareholders who are required to pay the state income tax. And then later on, at the end of the year, it figures out, all right, how many people have I paid tax on their behalf, and how many people I have not. The income tax on their behalf is really a deemed distribution to them. I need to do a makeup distribution for the other shareholders from whom I didn't have tax withholding. So if I didn't pay income tax on their behalf, I need to give them an equivalent distribution to make up for the fact that they didn't get this deemed payment. So it's okay if you just have the state income tax withholding, and at the end of the year you just kind of true everything up. I'm even fine doing it next year when you do their tax returns. I think that's fine too. But the idea is that you really do want to have an ongoing true-up process, and so you don't really worry about it. There's all these differences because you're always just kind of every year catching back up with it. So that should be okay. And you can see in my materials, I talk about temporary timing differences, and I also talk about disproportionate distributions. There are some cases where the majority shareholder, the controlling shareholder, really took advantage of the minority shareholders. In fact, the majority shareholder took distributions, and they didn't pay the minority shareholders what they should have. So they said, the majority shareholders, like they had 60%. So they took distributions. They didn't give the 40% to the minority. They just kept that money inside the company because they were trying to do a squeeze out. And that's what is commonly called a K1 KO. The partner gets the shareholders get a K1, they have to pay income tax on it, but they don't get any distributions. So they wind up getting hit with tax every year without the cash to pay it. So that squeezes them, and so that's a K1 KO. So there are shareholders who've in the past tried to do that, and the minority shareholders will say, well, hold on. This is supposed to be a single class of stock. They got distributions, I didn't. Therefore, you violated the single class of stock rules, and so the S election terminated. Therefore, it was a C-Corp. Therefore, I don't get a K1. Therefore, I don't have to pay taxes. I don't have a K1 KO going on. And the IRS and the courts have pretty uniformly said, too bad about the K1 KO. The tax laws say you're taxed on that income. There's nothing in the governing documents that authorizes this. So, you have state law rights. Go out and enforce them. Too bad. Just go out and enforce them. Don't try to use the tax system to protect yourself. You elected to pay taxes on it. You're responsible for paying taxes. Don't try to complicate the tax system for that. If you didn't get your tax distributions, you need to go and sue the controlling shareholder yourself. So anyway, that's what that's all about. Slide 19. There are some other parts that allow you to have things that don't necessarily provide proportionate distributions. So one of them is if you have equity type incentives. So you have employees, you want to incentivize them by giving shares, which, by the way, I think usually is not a good idea, but a lot of people like to do it anyway because they just insist on it. It gives the employee a feeling of ownership to also be a shareholder. And so you can have things that say, for example, if the employee got the stock because they were an employee, and then the employee does something evil like steals from the company, and you fire them, you could maybe cash them out or for below fair market value or maybe even for zero, and so there are times that you can provide for cashing out the shareholder employees for less, and so that part of my materials talks about that. Also, sometimes there may be post-sale price adjustments. So let's say, for example, that I own stock in an S-Corp, and my buddy David also has stock in the S-Corp, and he wants to get out. So I say, okay, we'll have the S-Corp redeem you, and it'll redeem you for what we think the fair market value is. And lo and behold, a year later, I sell the company for twice that value. Now, David might be kind of wondering whether I was really such a good friend or not, or whether I was pulling a fast one on him, because I sold it for so much more later on. So sometimes there will be a provision that says that if you have a sale that occurs after the shareholder gets bought out, then if that sale occurs soon enough, then that former shareholder will get a cut of the sale proceeds. Well, that might seem to violate the second class of stock rules because they don't own stock, but they're getting some distribution. So do they have some kind of a different right? And the bottom line is that those agreements are probably okay. because they're just trying to help the parties adjust their rights on the. It's basically an adjustment of the sale price rather than really considering to be a distribution. So anyway, there's that. There's special stuff for leveraged ESOPs that have been approved. There's some warrants that you may have times when the original shareholders might get diluted, and you may give some kind of warrants that will let them get put back into their position, so those warrants won't create a second class of stock. So those are just kind of miscellaneous provisions. Slide 20. Here you see that if there's a bona fide agreement to redeem or purchase stock, and it's due to death, divorce, disability, or termination of employment, that we are not going to consider the fact that that might change the purchase price or the distribution. So if you're redeemed at one level for death, another level for termination of employment, and another level for divorce, though that seems to be unequal treatment, and therefore maybe different distribution rights, and therefore maybe multiple classes of stock. But no, you can ignore those unless a principal purpose of the agreement is to circumvent the single class of stock agreement, and the purchase price is used as significantly in excess of or below the fair market value of the stock. So generally, I think if you do a purchase price somewhere between book value and fair market value, including fair market value, what we call the fair value, then I think that you're going to wind up being okay. If you have some kind of forfeiture clause, you might still be okay. We'll have to see. So we're going to talk about that in a moment. Going to slide 21. Well, there's a 2019 letter ruling where there was an equity compensation plan, and on termination of employment, the purchase price might be the full value or nothing, depending on the circumstances of termination. Because there was no intent to circumvent the single class of stock rules, these restrictions got ignored. So there was no second class of stock. Slide 22. There was a different letter ruling in 2019. And in that case, if a shareholder's voting stock was sold, then his non-voting stock had to be canceled. Not redeemed, but canceled. So like redeemed for zero. And then there's another circumstance that was listed as well. And basically the IRS said, no can do. Look on slide 23. The shareholder agreement violated the second class of stock rule. But what happened here was there was never any sale under this agreement. The agreement, the agreement was in effect, but nobody ever took advantage of it or never applied. And the IRS had no problem granting inadvertent termination relief. So what they said is, remove the offending provisions and we'll pretend that they never existed. And you can go on your way. So it's always good whenever you have a defect in your S-Corp that it may be a defect in the trust, whether the trust qualifies or not to be an S-Corporation shareholder, or whether you might have a second class of stock. If you think you have a defect, possibly, take a real hard look at it. And if you have any concern at all, then go in for a private letter ruling. Because the statute, Code Section 1362, parentheses F, says that the IRS is supposed to grant relief, be very liberal to taxpayers. Grant relief in pretty much all possible cases. And the only time they won't grant relief is if you're trying to pull a fast one on them. So if all of the shareholders who own the stock during the period in question when the S corp might not have been an S corp. All of those have to agree that they filed as an S corp and that they won't challenge the continued taxation of it as an S corp. And as long as all the shareholders agree, you can get that relief. Now, don't dilly-dally. Here's what can happen. Let's suppose there's a potential defect, and you're kind of like, we'll let the statute of limitations run, the IRS hasn't caught it. And then all of a sudden, a buyer comes along, and they want to buy your business. And they go do due diligence, and their CPAs notice, hey, there's a potential problem with the S election. Well, that's bad news. They're going to want to get that fixed. Now, let's suppose you have a strategic buyer, so they're paying way above what you think the fair market value is. You don't want to have anything delaying the closing of that deal. But a private letter ruling, if you go and call up the IRS, they will usually tell you that their time frame for private letter rulings is 6 months. Well, if you have a strategic buyer, you don't want to delay your closing by 6 months. Something might happen, and then you'll lose your beautiful sale price. So what you want to do is get that blessing from the IRS now, and not wait to get it later. All right, let's go on to slide 24. Finally, basically, the 2017 tax reform put in this Code Section 83I election, and that basically says that if you have qualified stock that's issued to qualified employees, then you can defer income tax on the issuance of that stock. Now, generally, and you can look at the statute yourself, you can look at my materials. Generally, the idea is that this needs to be stock that's like offered to all the employees, pretty much, or all the full time or whatever it is. I'm not going to get into all the details, but it basically needs to be a stock plan that is more widely available and not just available for one or two people. Now, there's two things about this. So first of all, you could defer income exclusion for up to 5 years for income tax purposes only. For payroll tax purposes, you got to pay the payroll taxes up front. So this is like deferred compensation in many ways, because for deferred compensation, you defer income taxation, but you pay the payroll taxes up front. Now, if you're not taxed on it, so suppose, for example, employer issues stock to employee, and the income taxation is deferred on the issuance of that stock. Is that employee treated as a shareholder, or do you wait until they have to pay the income tax to treat them as a shareholder? Well, I believe that the answer is that the employee is treated as the owner as soon as they get the vested stock. And they will get a K-1 from the S Corp for their distributive share with respect to that vested stock. So my materials kind of go through it. I don't want to belabor the point. This is not going to apply to too many people, but I just wanted to raise this whole point about this new provision for you so you've got it in case it happens to apply. All right, let's go on to slide 25. The last part of our discussion here, and this has to do with basis step-up. So I'm sure almost all of you know this, but I want to make sure everybody's on the same page. So what's basis? So if you buy stock for $10 and sell it for $50, you have a $40 gain between the $50 sale price and the $10 original cost. That $10 original cost is called your basis. If a person dies holding stock or anything else, then their basis gets changed from being the original purchase price to the fair market value on the date of death. So if you have assets that are included in your estate, then you are eligible for this basis step-up. Now, it's really a new basis on date of death. So the basis could be going up or down. Now, for our successful clients, generally that's going to be a basis step-up. So I usually talk about basis step-up. So, what if you have an irrevocable trust? So let's suppose at the time the exemption was $1 million, we were concerned about the kids potentially having estate tax. So instead of mom or dad giving the stock to them outright or in a trust that's including their estate, mom and dad said, I'm going to put this into a generation skipping trust. It's going to be outside the estate tax system forever, and that way we can avoid estate tax. So fast forward, now we have an exemption that would be on a permanent level, $6 or $7 million or so. It's 11.4 right now, but in 7 years it's going to go back down to about $6 or $7 million. So we have a permanent exemption of $6 or $7 million or so, and this $1 million trust is no longer needed to protect against estate tax. The kids might have had only a couple $1 million in their estate, and there's a lot of confidence here that there's not going to be any consequence. And this is particularly the case when you have a surviving spouse. Surviving spouse has what we call a bypass or credit shelter trust. So you set up this trust to avoid estate tax at the surviving spouse's death. Lo and behold, you don't need to save estate tax at the surviving spouse's death. You would rather get the basis step-up because it's not going to cost you any estate tax. So if you have this free basis step-up, several years ago at Heckling, Reed Moore coined the term freebasing for discussing the free basis step-up. So how can we do some legal freebasing here? So we're going to talk about how you get the basis step-up. We're going to talk about using the formula general power of appointment, and we'll talk about the tax consequences of a modification. And again, I do encourage people to write their questions in using the little question and answer widget at the bottom of your screen. Okay, so slide 26. Just to orient you to my materials, I do have a general basis step-up discussion, which is found within a discussion of income tax versus estate and gift tax. And the formula general power of appointment is just one of the tools. Slide 27, I go through a list of tools that relating kind of in your toolkit to get a basis step-up. So you can get the free basis step-up when this first spouse dies. So you have an unlimited marital deduction at the first death, and so there's no estate tax when the first dies, and any assets included in the grantor's estate will get a basis step-up. So that's a free basis step-up. Now, what about so that's the assets that the decedent owns. What about assets that the decedent's spouse owns? Do those get a basis step-up? Well, if you happen to live in a community property, such as California, where our firm has an office, then generally property acquired during your marriage, like from working, doing all your hard work, your blood, sweat, and tears, you acquired during your marriage, that's going to be what's called community property. And each spouse owns half of the community property. And if a person dies owning community property, both halves of the community property get the new basis. So the decedent's half gets a basis, and the decedent spouse's half gets a basis too. A very special feature to community property. Well, community property is only a minority of the states. In most of the states, it's what we call the common law system. And if you own property, you own half, and your spouse owns half, well, the only half gets a basis step-up. Same with jointly held property. Even tenancy by the entirety property, only half gets the basis step up. Now, what if you're in a common law state like Missouri or Illinois, and you don't have community property readily available? Now, one option that you could do is you could establish a joint revocable trust, a community property trust, in a community property state. That's one option. But maybe you don't want to go through setting up a relationship with a trustee in another state, and the initial setup cost and the ongoing cost of paying that person to be the trustee in another state. Plus, if that state imposes income tax, you also have other issues. And this is one reason why there are several states that allow you to do community property and don't have a state income tax. So that's why you want to use those. Well, but what if you don't want to mess with community property? Another thing you can do is something called a marital estate trust. So this is a trust that one spouse sets up for the other. It qualifies for the marital deduction. It is payable to the surviving spouse's probate estate. And if you set it up right, then the entire marital estate trust is included in the estate of the first to die. You heard me, the estate of the first to die, 100%. So you get the same benefit as community property. But it does require probate to do it. And that's in my materials as well. I definitely did not invent that technique. David Handler and I think Deborah was her first name, Dunn, wrote an article about it several years ago. So you'll see the citation of that. Slide 28. Another tool is doing what we call a QTIP trust, Qualified Terminable Interest Trust. And so for that, that's a trust where the surviving spouse receives all the income and is the only beneficiary. You elect to take the marital deduction for that. So again, you get the element of marital deduction at the first spouse's death. At the second spouse's death, the assets are included in the second spouse's estate, and then they get the new basis step up at that point. So you get a basis step up at both the first and second to die. And the nice thing is that you can elect to treat none, part, or all of your trust as a marital deduction trust under this QTIP regime. So that gives you some flexibility. Now, one of the issues is if the spouse gives away part of their interest in the part of their income interest in the trust, then it will trigger an income taxation gift taxation of the entire trust. So that's code section 2519 that will trap you with that consequence, which can be a blessing or a curse depending on the situation. I also have something in my materials about depreciable property. You can read that on your own. The other thing is that assets that generate income in respect of a decedent or IRD are not eligible for basis step-up. Typical example, you have an IRA, so the income inside the IRA was not taxed, and in fact, you might have gotten a tax deduction for contributing to that IRA as well. And so the IRA is basically a deferred income tax, and the fact of income taxation is locked in. Those assets do not get a basis step up. Okay, on to slide 29. Other tools in my materials, you can form a partnership and through a series of transactions, shift basis from one asset to another. Also, when a person dies owning a partnership interest, not only will you get a basis step up for their interest in the partnership itself, they can also get a basis step up in the partnership's assets. So partnership owns land. Not only does the partnership interest get a new basis, but the land also does. So there's a way you can elect to have that occur. That option is not available in S-Corps. I'm going to skip the next one. Slide 30. So if you have assets that have losses in it, you may want to avoid a basis step down. So you might want to give those away before death. I also talk about Untitled Chapter 14, and I also talk about the idea of a taxable termination, which is a GST event, versus a general power of appointment, versus what's called the Delaware Tax Trap. And the Delaware Tax Trap is the most flexible way of getting a general power of appointment, estate tax inclusion, and it is the most foolproof way to do it if you can figure out how to do it right. The only problem is a lot of people can't figure out how to do it right, or they're intimidated by the complexity. So most people will shy away from that. Okay, slide 31. Now we're getting into the heart of the discussion here. The mere presence of a general power of appointment is effective for basis step up or down, so long as the estate tax system remains in place. If the estate tax is repealed, then you get a basis step up only if the decedent actually exercised the power. Now, I don't think the estate tax will ever get repealed, but just in case it does, you never know what the politicians will do. Just in case it does, I wanted you to know about that fact. So that's something to be on the watch out for if they repeal the estate tax. Slide 32. In the state of Kurz, the decedent had a 5% withdrawal right in the bypass trust, which is exercisable only if the marital trust had been exhausted. The decedent also had an unlimited right to withdraw the marital trust. So slide 33. Therefore, the decedent could control whether the marital trust existed or not, because the decedent could have withdrawn the entire marital trust. So the court said, hey, because you could control whether or not the 5% withdrawal right applied, we're going to impute control over that entire 5% to you. So you had vested in you the right to control whether you had a 5% withdrawal right. So we're going to call that kind of like a vested right. So you're deemed to have that right whether or not you actually were able to exercise that right. So slide 34. The lesson of the case is that if the holder of a vested general power can change its scope, the full possible scope of the general power is included in the holder's estate. So the idea here is that, well, what if we do want to have a lot of flexibility and we do want to kind of give that person some kind of control over it? What you would want to do is to make the general power not be vested. So if it's not vested, then you don't really control it. So we're going to talk about it in a moment, but slide 35, I want to mention I do have this complicated formula here. But before we get into it, should you just use the KISS approach? Keep it simple, silly. So should you use that? Well, if the person who would hold the general power will never have enough of an estate to pay estate tax, then just give the doggone general power appointment. Don't do any formula clauses. Just say that that person will have a general power, period. So you can do that. But also be careful whether the holder might move to a state that imposes estate tax. So in Missouri, we don't impose an estate tax, but across the river in Illinois, they do, with the $4 million exemption. Or if you move up to Boston, Massachusetts gives you only a $1 million exemption. So be careful if you're going to assume that the beneficiary is never going to have to pay estate tax. Consider the possibility of state estate tax when you do that. Slide 36. Suppose you give a general power for estate tax purposes, but you really don't want to let the person exercise it. So if you want to have it included in their estate, but you really don't want to let them give it away and pass it outside the family. Or what if you do trust that person, but you're worried that maybe one day they might lose capacity due to physical illness, and so they don't really, their mind is not as sharp as it once was because they had like a stroke or something else, or dementia or something, or they just become frail and they're dependent on a person who then becomes a predator and controls them. So you may want to have guardrails not only for people whose judgment is suspect, but also just everyday normal people who life happens. So slide 37, if you have any of those concerns, consider requiring the consent of a corporate trustee. So suppose you have a power of appointment that says, son is the beneficiary, son has the power to appoint to son's descendants. And by the way, we want to add in there that son can appoint to son's estate, so that, or the creditors of son's estate is really what I would say. The son could appoint the creditors of son's estate, but only with the consent of a corporate trustee. Well, so first of all, putting in requiring the consent of a person who's not a beneficiary, that's perfectly fine. That does not prevent it from being a general power. At the same time, we know that the corporate trustee is going to say, hey, if I consent to the exercise of that general power, then the son's kids are going to sue me for letting it pass outside the family. So we have some identified beneficiaries with a stake in it. They're going to sue me. I will never consent to the exercise of this general power. And you may say, well, that's fine if they never can do that, because I didn't want them to exercise it anyway. I just wanted the estate inclusion. Now, the fact that the corporate trustee would never consent to the exercise, does that mean that they're adverse? No. Liability concerns do not make them adverse. Adverse means they have a beneficial interest, and the corporate trustee doesn't have one. So you can consider requiring the consent of a corporate trustee, or for those who shy away from corporate trustees, it could be a substitute non-adverse party approved by the family members. So maybe the mom might have a general power subject to the approval of somebody else. Instead of having to get a corporate trustee on board, the mom says, hey, I would like my friend to be the one to consent. Well, what if that friend is the pool boy? And mom is appointing it to her estate so she can leave her estate to the pool boy. That would not be too cool. So you could say that that it could be an independent person, but that the family members have to approve it. So mom can appoint an independent person. If the family members veto it, then she can just appoint a corporate trustee. But in any event, she can make sure there's somebody on board who can consent to it so she can exercise it. So slide 38. So again, the consent might be appointed only for the general aspects of the power. So if the power is son may appoint to his descendants or his creditors, son might get the freewheeling power to appoint to his descendants. That's fine, that keeps it within the family. But son's power to appoint to his creditors might be requiring the consent of the non-adverse party. Now, the other thing would be that if estate tax actually gets imposed by reason of this general power, then it would only be fair to allow the holder of the power to pay the tax. So in my example, if son has the general power, he should be able to say, I exercise my general power to require that the trust pay estate taxes on any assets included in my estate. He should be able to do that without the consent of a non-adverse party. because it's not like he's giving away the property to anybody. He's just using it to pay the estate tax and impose on the estate. That's only fair. All right, slide 39. Now we're getting into my formula. So there's language that I put into my newsletter and my materials generally. Again, caution. Do not try this at home. Okay? This language is experimental. I don't view it as being settled. I do it only when there's somebody who's really interested in a basis step up, and I can talk through this with them. So it's not a stock form language I use. So here's the first part. In the exercise of the formula power of appointment, it has to specifically refer to the power, and in order to exercise it, it requires a written document with the written approval of the appointment trustee. And it's revocable by either the person who holds it or by the appointment trustee. So, go on to slide 40. So because the appointment trustee can undo this at any time, this power is not vested in the holder, and I believe that this takes care of the Kerr's case problems. Now, my use of the word appoint is defined in other parts of the document to include a will or an inadvisable document, which can be revocable or irrevocable. And I like doing that. I had one time when I had just a simple, plain vanilla power of appointment that the surviving spouse could appoint, and they could appoint to their kids. One of the kids kind of checked out of the family, and the spouse didn't want to have them included anymore. And furthermore, we were going to be doing some things in the trust that required the consent of the remainderment of the trust. And so what happened is the surviving spouse irrevocably exercised the power to appoint in a way that cut out that estranged child. So then we didn't have to get that estranged child's consent. All right, slide 41. Here's another part of the clause. So the appointment trustee's decision to consent or withhold consent or revoke or otherwise limit the exercise of the power is in the appointment trustee's sole and absolute discretion. So we want to do whatever we can to avoid a lawsuit by it. Furthermore, the appointment trustee can reduce or eliminate the power, this general power. So again, this is not vested. It avoids the Kerr's case. So look on slide 42. Again, the last sentence drives home about not being vested. And the other thing is, again, I don't have complete confidence in this clause right now. So if the tax laws change, or if it finds out there's a flaw in the way this is done, or the situation of the power holder changes, it's nice to have an out. We can always appoint an appointment trustee. They can modify the power. They can eliminate the power, so we can get rid of this if for some reason it's not good anymore. Slide 43 talks about who's qualified to be an appointment trustee and the procedure for appointing them. Slide 44 makes a comment on that, but we're getting low on time. I'm moving on to slide 45. Slide 45, the formula power applies, doesn't apply to include assets that don't get a basis step up. So there's no reason to potentially subject to estate tax or whatever assets that don't get a basis step up. If you have a loss asset, we don't want to adjust the basis because that would be a basis step down. So loss assets are not subject to this general power. Slide 46 points out about that issue, what I just said. Slide 47, if after you eliminate those assets that we take out, everything is below the estate tax threshold, then the power of appointment is over everything. slide 48. However, if you should only include parts, but not all of in the estate. So if including the whole thing is going to trigger an estate tax exemption, I'm sorry, if part of the estate inclusion would generate estate tax, then you want to have an ordering provision. And that ordering provision would generally say, include in my estate only the assets with a lot of basis step up, don't include those that have a little basis step up. So there's an ordering provision. That's on slide 48. Slide 49 goes more into that. And so slide 50 kind of talks about how that works. But the other point is that some assets might be sold sooner than others. It could be that the assets with lots of appreciation are going to be held forever and ever and ever. But some with only a little bit of appreciation are going to be sold the next day after death. So you might want to change the order to get the basis stuff up to the ones that are going to be sold first. So the fact is that we do, in the next slide, slide 51, include the point that the appointment trustee may change the scope of the excluded assets and included assets and vary the order. So the appointment trustee, if it makes sense to have a different ordering than what's in my rule, the appointment trustee can take care of that. Create a new formula. Slide 52, modifying trust can have tax consequences if they change the beneficial interest and the beneficiary does not complain. And one of the problems here is if you change a trust and it still stays in trust for that beneficiary, under Code Section 2702, the beneficiary may have made a gift of the entire value of the beneficiary's interest in the trust. So my materials go into that in more detail. I want to point out a recent letter ruling that said that when you had a provision to have a trustee's consent required to exercise a general power, and it turned out that the trustee was forbidden by the trust agreement to consent, that kind of undermined the whole point of the general power. I mean, if the person whose consent was required couldn't consent, then you could never exercise it. So the letter ruling said, so basically what happened is in that case, the family wanted to go and change it to say that if the trustee was prohibited from consenting, there could be a mechanism for appointing an independent person to consent. And the IRS ruled that there were no gift tax consequences to changing the rules to allow an independent person to be appointed. So that's a helpful ruling. So before I wrap up, I had one question. I have heard that the IRS is not going to accept court order modifications to bypass trust on the Bas Doctrine. And have I heard about that or seen an audit or anything like that? So let me point out about the Bas Doctrine. The Bas Doctrine says that whatever you do, we will give retroactive effect to it only if it was consistent with state law. So if you're doing a reformation of a trust to say, oops, there was a mistake, there was a scrivener's error there, or this is not what the grantor intended, or this is how the trust should have been construed. If you want to do something that's retroactive, then that has to be consistent with what state law, what the state's highest court would have held. That's what's required to have retroactive effect. So that's the Bas decision. And there was a recent CCA, really about, I don't know, about a year ago or so, year or two, where the IRS said that a trust modification that added a power of appointment to charity would not be respected. And now, so people were concerned about that. But there is a revenue ruling 73-142, if I remember correctly. It's in my materials, that says that we will respect a state court modification regardless of the Bas decision, so long as you're looking for prospective consequences only. So if you're looking only for prospective consequences, we have a revenue ruling that allows you to rely on that. So I'm not really concerned about our court modifications of trust throwing things out. So conclusion, again, here are some resources for everybody. The Fiduciary Income Tax Refresher and Update from 2019, that's still available for browsing. So, if you want to go back and look about fiduciary income tax issues, it's a nice 90-minute summary of basics and also some advanced ideas. I have a blog that I write articles on from time to time. This is meant more for lay people. Every January I put out, I make comments on the ABA reports about heckling, so I have those. And then, of course, any of you who don't subscribe to my quarterly newsletter, I encourage you to do that because it will give you an update of my materials, which are over 2,000 pages long now. That was a typo there. My third quarter newsletter, I'm going to have a webinar on October 29th. So please reserve that. Also, I'm going to be doing a series of items on business planning, a series of monthly webinars. Those do charge a fee. They're with Lineberg. And the idea of those is, here I kind of split my hour and a half among 3 different topics, and I only go so far into each one of them. If you want to go into a deeper dive, 90 minutes on just one topic, then you can go listen to the Lineberg webinars, and it's a relatively reasonable price for the whole series. But I'm not here to sell stuff. I just wanted to let you know that there's an additional resource available. So thank you very much for participating in the webinar. Sorry I ran over this time. Please complete and submit the survey located in the widget at the bottom of your screen. And I look forward to talking with a lot of you, I hope, with the next webinar on October 29th. Thank you very much.